Hello YouTube friends, and welcome to Grow Money Seeds, a channel about building wealth and managing your money. In this video we discuss why investing in the stock market yourself and not using a fund manager may just put the odds in your favor to beat the market. So let's get to it. Right, so you've got to the point where you have a little extra cash on hand and you're thinking to yourself, what's the best thing I can do to grow money seeds? I know, I'll give this money to an experienced fund manager and they can invest this for me, beat the market, and after a few years I'll be rich. Okay, slow down a bit. Let's do our homework before jumping in. The first part of your thought process is correct, and the best thing you can generally do to grow money and fight inflation is to invest in the stock market. If you are new here, or even slightly unsure of what inflation is, then I have a video about inflation which I strongly suggest you watch by clicking here. The second part is that you may want to consider doing the investing thing yourself, as you might just get better returns than that experienced fund manager. Let's start at the beginning so we understand more about fund managers. What is a fund manager? A fund manager is a person or a group of people that invest your money in the stock market, and they use various trading strategies to try and beat the market and make you more money. To do this, they get paid a percentage of the amount you invest. What does it mean to beat the market? The S&P 500 is an index that measures the performance of the top 500 large cap stocks listed on the American Stock Exchange. This is most commonly used as the benchmark for the overall stock market performance. Since its inception in 1926, it has averaged an annual return of 9.8%. To beat the market, an investor needs a higher average annual return than the S&P 500 for that year. In other words, if a fund had an annual return of 15% and the benchmark is 10%, they would have outperformed the market and beat the market. On the flip side, if they had an annual return of 5%, they would have underperformed relative to the market. Do fund managers beat the market? Absolutely not. Research by the S&P Dow Jones Indices, which was last published in April 2020, actually shows that in America, 89% of fund managers fail to beat the market. Even if you look at the performance of fund managers that invest in mid-caps, small caps, all caps, the numbers are much the same. Most of the fund managers do not beat the market. Some fund managers are able to beat the market for 1 to 3 years, but over a longer period of 10 to 15 years, research has shown that they become less consistent and underperform relative to the market. Now, you might be thinking, those American fund managers don't know how to invest. It can't be like that in Europe or Australia or even the rest of the world. The following infographic shows the percentage of funds in a country where the market beat the fund managers. Over a 5-year period, only 19% of fund managers in America beat the S&P 500, 22% of fund managers in Europe beat the S&P Europe 350, and 19% of fund managers in Australia beat the ASX 200. Why do fund managers battle to beat the market? As mentioned earlier, fund managers take about a 2% fee on the money they invest each year. This means that even if they outperform the market by 1%, they will still underperform the market once their fees are subtracted. There is also something called career risk. Fund managers will be averse to taking too much risk, because if they're too aggressive, they might lose money and investors will pull their remaining money from the fund. The more money a fund has under management, the more the managers get paid. Large funds have a lot of money to move, which means that when they buy stock, it can cause the price of the stock to go up, and then they get a worse price. And conversely, if they sell, this can cause the price to go down, and again they get a worse price. Finally, some funds have mandates, which means they have to hold a certain percentage of stocks, bonds, or even cash, and this limits what the fund can and cannot invest in. Do you need a fund manager to invest in the market? No. As a regular or retail investor, you can invest directly in the market yourself. You just need to be over the age of 18, open a brokerage account, and have some basic knowledge and a trading plan. In fact, it may be better not to have a fund manager. The fees can significantly erode our returns. If Fund 1 invested $10,000 in the market for 20 years with a 10% return, our total value at the end of the investment period would be $67,275. If Fund 2 invested the same $10,000 for 20 years at the same 10% return, but there was a management fee of 2%, our total value at the end would be $45,754. We would have lost just over $21,500, almost a third of our return in management fees. In 2018, Warren Buffett made a $1 million bet that hedge funds would not beat the market over a multi-year period. In 2016, 5 hedge funds, A, B, C, D, and E, had an average return of 22.04%, and the market index returned 85.4%. The market beat the hedge funds by almost 4 times. One of the reasons for this is the high fees charged by these funds. How does a normal person beat the market? As you can see, beating the market is not easy. But as a regular investor, there are a few things we can do to put some of the odds in our favor. We can invest in the market ourselves. This immediately eliminates the fees that are charged by fund managers, and this gives us a huge advantage. We don't have mandates that govern what we can and can't do. We could have 100% exposure to stocks, or we could be 100% in cash. There are also different trading instruments, like options, that we can use to leverage our money, insure positions, and improve our chances of success. If someone is new to investing and they are looking for a strategy to beat the market, I would suggest buying an index or an exchange-traded fund, also known as an ETF. ETFs are made up of a basket of stocks that track the overall market or certain sectors. The SPY ETF tracks the general market, which has had a return of 13.17% over the past 10 years. The QQQ's ETF tracks the technology sector, and this has had a return of 20.46% over the past 10 years. If I was investing $10,000 in the market today, I would use half of my capital to buy the SPYs, which would give me a market-related return, and the other half I would buy the Qs. Past performance does not guarantee future performance, but this would have given me a return of 16.81%, which would have actually beaten the market. Summing it up, investing is one of the most effective ways of growing our wealth. However, using a fund manager may not be to your advantage. The take-home points from this video are to show you that fund managers have no major competitive advantage when it comes to investing your money. Their fee structure can significantly erode into your investments. Investing in products yourself, like ETFs, can diversify your portfolio and spread your risk, and over the long run, just might help you beat the market. Don't be afraid to manage your own money and take control of your own investments. It's a lot easier than you think. One of my goals for this channel is to show you step by step how to invest in the stock market, and in future videos will be dedicated to this. Now would be a good time to click the subscribe and the like buttons so that you're notified when there are new videos. Thanks for watching.